From the morning reading, the Qs XLY, which is discretionary. Amazon make new all-time high. Breadth weakened compared to the prior session slightly as advancers led 1823 to 1182 on the New York Stock Exchange and led 1724 to 1160 on the NASDAQ. In other news, crude oil has enjoyed a nice few days. That market has rallied more than 1% each of the past 3 days, coming off a recent multi-month low. It managed a similar feat 3 other times in the past few years, all failing almost immediately and leading to a new low. Historically, that has been more the rule than the exception. A minor blast-off in financials. The XLF fund rallied more than 1% on Thursday, a relief from recent pessimism. The 10-day average of its optimism index was showing extreme negativity coming into the day, and when it has rallied strongly from other bouts of pessimism, it tended to keep adding to the gains. Early weakness, late strength. SPY gapped down at the open and then closed in the upper 75% of its intraday range for the past 4 days. In its nearly 25-year history, it did this 4 straight days only once before, on February 15th of 2011. It rose for another 3 days before falling into a pullback. There were 14 times it did this 3 days in a row. Over the next week, it rallied 5 times, and the average return of it is negative 0.6%. The pattern of weakness persisted up to the 3 weeks later, then gradually improved. Heavy construction and mining stocks test the 200-day averages. So are energy shares as crude oil strengthens. Percent of New York Stock Exchange stocks above the 200-day average remains strong. Consumer discretionary spider hits a new record. Small caps outpace large caps. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:32 a.m. Mountain Time, and I'm recording this in preparation for the market day of March the 31st, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce into the morning report. And at the time of this cut, a little bit of weakness, but nothing significant on the 4 U.S. broad-based indices. The S&P futures, Russell, NASDAQ, and Dow were all down just below scratch. Crude oil is down about 1/3%. Euro's down just below scratch, as is the long bond. Gold is down about 1/3%. And overseas action, it looks like a lot of weakness there as well, with the one exception of China, which is up about 1/3%. Hong Kong down about 0.8%. Japan down, also down about 0.8%. Germany down just below scratch. United Kingdom down about 0.5%. In macroeconomic reports for the United States of significance for today, we have core PCE price index, personal spending, Chicago PMI, FOMC member Kashkari speaking, and the University of Michigan consumer sentiment reports. So pretty good schedule here for today, and some of those are occurring during market hours, so be aware of that. In terms of current volatility conditions, obviously we had a bit of weakness, a little bit of a pop in volatility off of extremely low levels to still low levels, and then that has largely resided. Short-term VIX now back down to a 9.58. Skew still elevated. Skew's been elevated during this entire recent weakness. 138.84 is your value there. In terms of implied IV percentiles, the S&P at a very low 7, the Russell 12, the NASDAQ a 10, and the Dow a 20. Those all remain exceptionally low. On a close-to-close basis, no index put in a standard deviation size move yesterday, though in recent days the NASDAQ's been the one that's been the most active in a positive manner. And let's see, let's go ahead and go to the charts. In our S&P chart, we had a downward channel going until yesterday, which was a breakout of the short-term pattern. Now, The intermediate to long-term patterns are still bullish, are still above the clouds, still above all the key moving average lines. So this was a bit of a counter trend move. And then we had a breakout from that short-term move yesterday. Now, some other folks are reading this move as up against resistance, and I'm not really seeing that myself. I suppose if you drew resistance as the bottoms of many of these bodies right here, that you'd be right up against that resistance. It's not usually the way I draw my support and resistance lines, but some people do use closes instead of the extremes of price action. But anyhow, I thought I would mention that just in case you're seeing that. We certainly seem in the overnight session to be moving back away from that closing level from yesterday, so there may be something to that. I would see this as either a short-term kind of weak resistance at the most. I would have put more credence into this downward channel than I would have a resistance area right here. Either way, we're right at a precipice where we need to see either a kind of confirmation of this breakout and the short-term pattern busted and move back towards new all-time highs, or we'll likely see a continuation of the recent deterioration and the short-term pattern to persist, and this just to be a false breakout. So either way, you're going to see this as something of a kind of key point, inflection point in the short-term pattern of the market and see where we go from here. So not terribly obvious from a probability standpoint and chart patterns as to which way that's likely to break. In terms of the Dow did not largely break with yesterday's action. You know, we're still not gotten a higher high or, of course, the following higher low. It's still in a short-term pattern, which is somewhat bearish. The NASDAQ, of course, went to a new all-time high yesterday, so by definition, that's extremely bullish. And while we did have the breakdown in the NASDAQ, along with the others in recent action, it's been basically straight up ever since then. Now, there are a couple things to keep in mind. The breadth of the NASDAQ, you know, could be called somewhat into question. Apple has been absolutely on a tear, and you look at this pattern since early December, really since the election. Ever since the election, Apple has gone from a low of about 104 to now 144. So, you know, that's approaching a 50% move in the world's largest company by capitalization in a relatively short period of time. And during that time, if you had tried to be short on Apple, you have been absolutely plastered. So nary a negative day hardly of any significance in this entire time frame. So Apple is a big part of that NASDAQ move. Also, XLY, the consumer discretionary, has also been doing well. And interesting enough, consumer staples has not been doing so well, and certainly not as well as consumer discretionary. So this kind of risk-on part of the market, and especially with respect to the likes of Apple and others like that. Let's take a look at Amazon. You see yesterday also Amazon had new all-time high. Not quite the same pattern as Apple, but still all-time highs for a very large component of the NASDAQ. So that is a big part of why you've got your NASDAQ futures at all-time highs. In other markets, crude oil also has been making some significant moves of late. You heard from one of the morning authors, though, that this particular pattern doesn't necessarily lead to huge profits. In fact, it often sets up for a new short. So be sure to watch this. We need to see if we can indeed get up through the key moving average lines, through the cloud, make new all-time highs. Remember, we had significant resistance up here, and it failed mightily from that area. So we'll have to see if crude oil can actually make another run to those all-time highs, or if indeed the probability play would seem to be to set up for another leg down. In terms of gold, gold has had a bit of an inflection point. We've got something of a double top here in recent highs, and that resistance has proven to be somewhat, at least short-term, a difficulty. So we'll continue to watch this. One could argue that the long-term pattern on gold is bullish, and one could argue that it turned direction and went to the intermediate term pattern is bearish, and then this is just a counter trend, a complex counter trend. Gold has been one of the more complex charts in recent months, and certainly this play here, whether this is counter trend, it's certainly having some difficulty in making higher highs. If it is a complex counter trend, it is making similar highs and similar lows in the most recent price action. So very, very difficult to pick from this which way gold likely to go. Based on current action, we're above the cloud, above key moving average lines, but up against resistance. So to set up for a long, I probably would want to wait at least until I break out above these two highs here and see if we could not make a run up towards this 1300 plus area. In terms of bonds, of course continue to be quite weak in both the short and intermediate term, and we continue to make this series of lower highs and lower lows, and I would expect that the next major swing on this would be to take out the 145.26 handle and make another new low. That would especially be in correlation with equities making a new high if they were to make that run. Now, one of the tells on that, of course, is with volatility. We did have a little bit of an increase. Never had a VIX spike by definition. We never had a close that was more than 3 points higher than the prior close. Had a bit of intraday volatility and so forth, and certainly we did have a close that was the highest close in quite some time a few sessions ago, but look how fast it got crushed. Well, actually, this would have been the open, this would have been the close. Even during that day in which we set this and peaked up above 15, by the end of the day, we would have closed down here around 12.5 and then follow through the next day all the way back down to 11.5 once again, and we continue to trade around that area. So by definition, below a 12, very low volatility, and even when we do peek our head out for a short burst, it is quickly crushed in the current environment. There's just simply no fear in this environment at this time. Let's go ahead and go to the daily report. And we continue to have some mixed signals, mostly coming from the shorter term indicators. In terms of intermediate term, we have, which is our primary time frame, by the way, intermediate term phase opinion, market phase 5, the break of diagonal and horizontal support. There is move to, with yesterday's action, we closed above both the key moving average lines, and this could be flipping with the next session or two back to market phase 4 or some other bullish phase. However, we're going to continue to consider this at this point a weak signal because we've been oscillating back and forth between market phase 4 and market phase 5 in recent weeks. In terms of the three market timing signals, we have some flies in the ointment for the bulls. We are still with the first signal uptrend under pressure. And so that is a warning sign. GMI index, though, is at a 4 out of 6, and it's retained its buy signal and its bullish stance ever since November the 10th. In terms of the third one, Stock Charts Decision Point Scoreboard, we continue to have these relatively weak short-term signals, but that's up against intermediate and long-term signals that have pretty much withstood all the recent price action and weakness and have still remained in a bullish stance. So overall consensus here is still bullish for the intermediate to long term, but some short-term weakness that's currently been playing out. In terms of the position sizing models, both models are somewhat lower. We've got the first model at 50%, the second model at a 75 to 100%. Intermediate term market posture, we do have a new signal to weak bull. This is a first day signal, and often first day signals are fraught to fail and flip right back the other way. We do have a neutral sentiment line, so no real help either way from that indicator. The intermediate term market posture for the S&P, actually this should be in black, it is a first day signal to the bull side. Dow still in strong bear, NASDAQ in strong bull, and Russell in weak bull. So you can see there's a lot of mixed signals going on here with primarily to the bullish side, albeit to various degrees of strength. Hedge warning status, we have dropped to a level 1. We were at 1 plus with yesterday's session. So some elevated risk in the market, but certainly it's a transition level. Level 1 gets our attention. We start to take a close look at things, and yet at the same time, it in itself is not a high risk environment. That's more of your level 2. When we start to see 2, we start to get really, really concerned about increasing risk in the market. And right now, we just seem to be happy to stay with level 1. And we'll wait and see which way we start to go from there. Does this eventually continue the short-term pattern and we start to see 1 deteriorate to 2, or do we see it bounce back into the more normal levels that we've experienced for most of the time in recent months? In terms of the strategy opinions, VIX is below the acceptable threshold to initiate new positions for novice traders. VIX is very low premium right now, being offered up for taking the appropriate amounts of risk. So that's something of a warning. Cover calls and put selling at level 1, very, very conservative at initiating of new positions. If you're going to do something, probably in the put selling, especially in those positions and the scale you are willing to own. In terms of specific areas of warning, you can see not so much red as we've had in some recent sessions, but still quite a bit of red here, as you would expect when you're at hedge risk level 1. Oddly, relatively low volatility, but yet we have a relatively high distribution day count with 5, and that's a warning status for both the NASDAQ and the S&P. Skew continues to be elevated. In the trend-based area, we have this market phase 5, but that might be turning, so kind of a weak one there. We actually just went to first day strong bull on the this one here, and then the new highs, new lows were relatively benign yesterday, not achieving any kind of thresholds. Intermarket risk aversion indicators has been actually quite negative, but it's been improving of late. You got number 3 here that is rolling up, about to cross over into a risk on status, and then this last one here is already in risk on. So some improvement starting to show in the intermarket risk aversion indicators. From a sentiment standpoint, pretty neutral really, and you see the fear and greed index at a 43. It's been coming up. It was at a 30 a week ago, and it's just about to come into the more neutral status itself. In terms of sector-specific, financials were the big winners yesterday, and in fact, if you look at it, it really was about risk on versus risk off. Financials, industrials, energy, consumer discretionary, all doing well yesterday, whereas down here at the bottom, you have healthcare, consumer staples, utilities. So, and here's real estate. Your more defensive areas of the sector were the lesser performers for the day. In terms of market postures, quite a bit of improvement here. We see a lot of neutral still, but still these are all improvements over recent days where we had a lot more red showing up on these different time frames of market posture by sector specific information. Perhaps the thing to focus on is who's doing the best in the most consistent fashion, and that would be consumer discretionary, that would be technology, and then I would follow that up with materials and industrials as being the most consistent, stronger performers amongst the sectors. And in terms of percent change, we kind of benchmark recent action against the 1 and 3 month, and you see the 1 month largely negative. And in terms of strong performance, information technology, consumer discretionary, certainly they continue to pop out. And you look at consumer discretionary here, 7% on the 3 month, nearly 2% on the 1 month, nearly 2% on the week, and yesterday it was up about 2.7. So that has certainly been the place to be. Now, within consumer discretionary, let's do some digging in. Look for individual industry groups and individual symbols that are driving that performance, because it is not universal. You could actually do a lot better than 7% if you're in the right components of the consumer discretionary area. Okay, that should be enough for today. Let's go ahead and start wrapping this up. And we're a little over 20 minutes. We've not published in the last couple sessions. Let me go ahead and get to the disclaimers and get this published. If you see a slide with something of interest, just hit the pause button. Disclaimers as always. Hit the pause button if you need more time to read the disclaimers. Also note on the bottom the hyperlink that takes you to the full set of disclosures. Manage that risk, be consistent, and good trading.